Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you today, Martin?
Pretty good. Yourself?
Pretty good. Running short of a little bit of sleep. Louis got another tooth coming through, so it's been a pretty interesting
Oh,
week in our household. But that's not the only commodity, Martin, sleep, that's gone up in price this month, which we'll get to.
I was going to say sleep's the most important, and unfortunately, it is a bit hard to get sometimes, isn't it? Yeah.
That's right. Before we dive into it, there's a lot of interesting things happening. We've got the housing, the stimulus that's been announced, the Aussie dollar is on a tear. The riots have taken off in the US, but anything that you want to add to the overall picture of what's happening before we dive into the slides?
Well, only to say, I think that there's a really interesting discussion about short term, long term, right? So, some of the things that are happening short term, particularly in the markets, seem to me to be very disconnected from the real long term story.
Yeah.
And so the question is, which is going to win out? And that, for me, is the really, complex and difficult question. Because if you look at what the markets are saying, they're saying everything's fine. The virus has gone away, economy is booming. But if you look at the real data, then over the longer term, then you may have a different view. So it's complex.
Yeah, and that's something that we've been saying on the channel for the longest of times, that don't expect the markets to represent what's going on in the economy. They're different parallel universes, and I think that's just abundantly clear. And Jerome Powell was out saying that Fed actions definitely do not influence markets. But I've got some digging I've done, and I think it was 12 years ago, and he was explicitly saying that he doesn't like this QE and money printing because it's going to push up the markets, lead to risk taking, and they're never going to be able to undo it. So he's actually
Yep.
contradicting and lying to himself, which tells you everything you need to know about what they say publicly versus what they talk about.
And just to say that, did you see that there was evidence given by one of the other people, senior people at the Fed, that basically said they're going to be going into bond buying for at least 5 years.
Yeah.
So there is no intention or even wish in the Fed to think about pulling back from this anytime soon. They see this is the new normal for the long haul. That's one of the reasons why the markets, I think, are behaving the way they are.
And I think they want to project that really confidently, as if to say it's not a big deal. Like they just play, oh yeah, this is normal, printing money for 5 years now. And so the markets are trying to, I guess, price that in and act a bit surprised. But can they convince people that this is not a big deal to print $1 trillion every week if that's what you need to do? That's just normal now. Yeah.
Well, and remember, all of this money is flowing into the financial system, and it's supporting the financial system, the hedge funds, and the other big investment banks. So they're actually enjoying it because they're actually getting all of this extra support, and then it flows through to corporates indirectly. But it really doesn't hit Main Street very much, and that's the real disconnect, right? Disconnect between what's happening on Main Street, where in the real world unemployment's high and all those things, and what's happening in the financial system. And the question is, do the two ever come back together, or are we actually now in an Alice Wonderland world where effectively the financial system sets off in one direction and takes the 1% in that direction, and everybody else is somewhere different?
Yeah, and I think Powell really purposefully said we're launching Main Street targeted programs, and they were meant to launch it this week. I don't think I've seen the exact announcement, but it's no coincidence that the riots have started. People are upset. There's some inequality in the air. A lot of these things have just bubbled over, and the Fed are saying we're launching Main Street programs soon, like trying to calm everyone down.
And I do think that the riots, and I know it's a horrible story and all of that, but the riots have moved beyond just essentially the one incident. People are beginning to wake up over there that there's massive inequality, and that inequality is wired into the way the economy works. And frankly, there are some similar inequalities here in Australia too.
Absolutely. Okay, let's dive into these fantastic slides you prepare for us, Martin. So, the RBA statement. I just probably want to touch on the fact that I think Philip Lowe, I keep saying this, I think he's too nice, and he's not an aggressive central banker. So he hasn't come out and said we're going to print trillions and do whatever it takes, and and that's why one of the reasons I think the Aussie dollar's held up a little bit better. But do you want to explain your thoughts on this statement?
Yeah, well, I agree. And, the statement on Tuesday was quite interesting because it really does paint a very dim picture. He's saying this is a difficult period. It's the worst since the 1930s. We expect unemployment to stay high, et cetera, et cetera. All of those things. And then he goes on to say, and of course, we'll go on doing whatever we need to do to try and actually move back to our 2 to 3% inflation rate. Good luck with that, right? I mean, all of the expectations are that we'll never see that level of inflation in, not at least over the next 5 years. Interest rates will stay ultra low. He's also previously said that negative interest rates isn't something we want to consider here in Australia. Other people probably would say, well, actually, there may be some benefit in negative rates. And of course, Westpac came out this week and said there's a sensible argument that they could amount to say that at the wholesale rate, in other words, between the central bank and the banks, going into a negative interest rate might stimulate the banks to lend more. Internationally, that hasn't necessarily followed. And then, of course, if you look in Germany, negative rates have been there for a long time, and now more than 100 banks in the US are offering negative rates on deposits. So I think you're right. Phil Lowe is being very nice about things, and he probably genuinely believes that negative interest rates aren't coming here. I think we probably should not completely discount their prospect later, but the markets are assuming that we're going to get away pretty much scot-free. Once again, Australia and Magic will win out.
Yeah, and I think it was the Bank of England that was starting to price them in and talk about them being a tool after they just said a few months ago that it wasn't helpful. And interesting that Westpac.
It was a week difference. So one week they said we're not going to do it. The next week they said we probably will. We might well do. And then of course the gilts, which is the UK bonds, they actually offered a negative yield.
For the first time ever, I saw that. And they're starting to still be priced in the US. So there's no way that Australia is more special than the US and the UK. Yeah. But it was interesting that Westpac said that, because we know that it's the banks that typically their margins will get compressed, and maybe it has some initial effect, but I just think that all evidence says that it weakens your banks. So why do we have banks maybe suggesting negative rates?
Well, maybe Bill is actually trying to support the broader economy, or maybe there's another agenda. But yeah, all of the research says negative interest rates kill bank profits, forces them to become more speculative, and basically stops them lending to for productive purposes. There's no sense to it, but there you go.
Okay. All right, so moving on, GDP, and this was the sort of the GDP that was going to either save us or put us in recession, and it did come in weak.
Minus 0.3, right?
Yeah, so, and I guess Treasurer Josh Frydenberg didn't waste any time and admitted that, we're in recession.
Well, he sort of said that we probably are in recession now. Next quarter is going to be worse. And then, of course, they went on to say, but relative to everybody else, we're doing pretty well. We're better than the GDP of the OECD, and we're better than most other countries. But yeah, the 29-year positive outcome, which really, frankly, has been stoked predominantly on migration and on the back of the resources sector, has come to an end. And I think there's an important point here. Had it not been for the significant government input, then the GDP, from what the ABS said, would have been minus 0.6. So all of the stuff, all the money that the government's been throwing into fiscal terms in the last quarter helped to move the number a little bit closer towards zero, but it was still negative. Next quarter will be deeply negative.
Yeah, and I guess we do have to say that Australia was relatively better than a lot of these other countries. China down 9-10%, all the big economies getting hit 2%. So we do have to give Australia some credit there, and we're waiting to see how bad this next quarter is going to be.
Yeah, and then of course the question is how quickly do we bounce back? Now, just a sidebar, we've said before, GDP is a really bad measure of anything useful, right? So it's all about activity, whatever it is, good activity, bad activity. I've always believed we need to move the conversation beyond GDP, and yet all the economists all around the world, and indeed all the central bankers, still think that GDP is a way to measure what's going on. I think it's very, very myopic.
Because I guess what you're saying is artificially we can increase immigration and get people to build houses and roads to nowhere, and GDP looks pretty on paper, but you're not really doing anything. Yeah,
you're not actually creating, a better lifestyle for the people in the country, or I think a well-being measure or something like that should be in the mix. New Zealand's been talking about doing it. There has to be a better way, because actually just doing more and more and more and more, building more, or encouraging people to borrow more, is very, very narrow in terms of actually thinking about how to build a sustainable, long-term, prosperous society, in my view.
Absolutely. Okay, so next up we've got underemployment, and the ABS data ticked up towards the Roy Morgan data that was maybe a bit more accurate or a bit more ahead of time.
Yeah, so Roy Morgan, of course, comes out with their alternative measures, and they're now saying that if you add unemployment and underemployment, and that's really important, underemployment is, the missing factor in the ABS numbers. It's 24.5%, so a quarter of the working population are effectively either unemployed or underemployed. I mean, that's a very, very stark number. And so the ABS unemployment and underemployment is at 19.9. So, the Roy Morgan is higher. The ABS unemployment number was 6.2. But of course, people on JobKeeper, people who are not looking for work aren't included in those numbers. So the ABS number is artificially low, and JobKeeper is part of that. And just, if you basically just reflect on this, what Roy Morgan said before the lockdown and now, another 1.07 million Australians are unemployed, which is up 7.5%, and 9.7% of the workforce are underemployed. 9.7%. I mean, these are huge numbers. That's why people need to be very careful about saying, oh, everything's fine, the economy's bounced back. And in fact, my data from the SME sector is saying that many SMEs were okay for the first couple of months, but now it's really starting to hit because the order book dried up. They had a couple of months of work, 3 months of work, and now the order book's dried up. There's no work. So actually, SMEs in particular are looking really, really bad. And I think the next 3 months for them will probably be one of the tipping points that will drive the economy negative.
Yeah, and it's a confidence game. If you're a small business with 10 staff, maybe open up with 5 to see how you go. And if everyone maybe just took the plunge and said, I'm going to open up with 10, then obviously it becomes like a self-fulfilling prophecy where the business next door only puts on their 5, and then they see the numbers and they say, oh, well, everything's down 50%. So it's not just going to be lay off 10, back to 10 in a month. It really is something that I think is going to take at least a year to get back to where it was.
Yeah, and most people, even the Reserve Bank is saying end of next year, unemployment will have a 7 in front of it. We had a 5.2 before, and of course they want 4.5. So you can just see how far the gap is. And unemployment and underemployment translates into real pain for many households.
Yes. So the confidence, which we just touched on, has bounced back a little bit from its worst ever reading, but it's still relatively low.
And it's interesting how the media reported it, right? They all said, hey, your confidence is booming. No, it's not. No. From a very, very low base of a couple of months ago, it's improving, but it's still way down. In fact, it's close to where it was through the global financial crisis. And, my data is showing a similar thing. There'll be a slight bounce back from the very low levels, but confidence is not great. And, they're saying that 24% of Australians are expecting good times for the Australian economy over the next 5 years, compared to 17% who are expecting bad times. Who knows over 5 years? Those are pretty rubbery numbers. But yeah, confidence is back a bit better, but it's not necessarily translating into more retail activity, for example.
Yeah. So households are saving more, and this is something we touched on in the pre-interview. We've seen in America a huge jump. I think it was from single digits up to 30%. So whether or not these figures are accurate, but even with interest rates at these record lows, people aren't spending. People are saving whatever money they can, and they're worried about, I guess, knuckling down because there hasn't been too many rainy days lately.
Yeah, so the savings ratio isn't necessarily a sign of confidence, right? And when people are actually worried about the future and uncertain about the future, they will tend to hold money rather than spend it. So we're seeing quite a lot of growth in term deposits and in terms of bank deposits from those people who are, for example, there are people who are receiving much more income than previously because of JobKeeper, right? So you were earning this much, now you're earning this much because of the minimum that's being paid out, and so you're saving some of it. So maybe that's not too surprising. That's, I think, a worrying issue. But of course, if you look at it, it's still quite a lot lower than where it was back in March 2008. So chances are people are going to go on saving a bit longer. In the US, yeah, the number's massively high. A lot of people are suggesting that the numbers are just not reflecting reality, and there are various factors that they can point to. I won't go into it in detail now, but yeah, got to be careful with some of these figures because obviously there are different ways of reporting and different time periods and things like that. But this is not a good sign. This is a sign of many people just being concerned about how things are shaping up at the moment.
And does that number, obviously it excludes the people that are spending money, but in terms of what counts as saving, is that if you pay down debt, or is that still a form of spending your income?
So it's basically what's available. So yeah, it's if you're paying down debt, it doesn't really reflect in the savings ratio. Oh well, it does indirectly because it's the other side of the equation. But
Okay.
it's more about if you've got money, what are you doing with it and where are you putting it?
And I think a lot of people are using it to pay down debt.
Oh yeah, oh yeah.
Yeah.
Owner occupiers in particular are paying down, and it's my view has always been it is very smart to have less debt rather than more debt. And I know that's a very unhip thing to say, and the banks would hate me for saying it, but actually more debt isn't necessarily good, particularly if you're uncertain about your employment prospects. And my data is showing me that there are more people now worried about their employment prospects than a year ago, and the number of hours worked is down. So all of those suggest that if you've got funds, paying down debt is probably a reasonably smart thing to do, even at these low interest rates.
Yeah. All right. So mortgage stress, it has eased a little bit in May. Is any reason for this, Martin?
Yeah, so a few things. The first is that it's 37.5 now rather than just over 38. And, job keepers come through. So some people have got some of those income flows they didn't have previously. More people have negotiated interest and principal repayment to holidays from the banks. Some have switched over to interest only, which is, remember 2 years ago, everyone was saying this is interest only is really bad because you have to pay the capital off. And it was mentioned during the Royal Commission. And in fact, the regulators were saying, don't do that. Now, that's all changed. So it really is interesting to see that the banks are pushing interest only. So all of those things. And there's a few people come back to work, which has helped, but there are other sectors that in fact are less. And I'm watching a lot of, sole traders like, people, for example, self-employed journalists. That's one example, right? People in the entertainment sector who just have no income at all at the moment because effectively it's all dried up. So I think that sector is where we're seeing a lot of the pain as well.
Yeah, I think we've seen a conscious effort from the banks to push this interest only, or they're trying to get people through because they actually don't want a wave of defaults. It's bad for them, and even if they can kick that can down the road interest only, they still end up making more money just over a one extra year period. So I guess it does help people out in some degree on your definition of help, but they don't really want to just be foreclosing, have all these houses on their books, do they?
The last thing the banks want is to report higher default rates. And of course, APRA's given them more wriggle room. So they're saying anybody who's got the interest and principal holidays, that's fine. That's not a default. If you switch to interest only, that's fine for an existing borrower. You hardly really have to do any further due diligence on them. Just switch them across. This is, a remarkable set of initiatives from the regulators and from the banks. The last thing the banks want to do is to end up with defaults, because if you start moving towards defaults, you have to put a lot more capital aside, and the banks don't want to do that. So that's why we're seeing what we're seeing. This could go on, but remember, I keep having to say this, if you're an interest-only loan, at some point that capital has to be repaid one way or the other.
Yes, and that's why they took their foot off the Royal Commission changes that were meant to be implemented. They're not putting those changes in anytime soon because they... anyway, I don't know what they're thinking, but it almost says to me, keep that dodgy behaviour going for the time being. We need to get a few more people across the line, and then we'll worry about cracking down in 6 months or a year.
Well, I don't think they can crack down. That's the problem. So this is going to go on. So, and remember that if you have interest only, it means you're not paying capital. That means the balances on the loan on the bank's books go up, so they can actually claim loan growth. Right, that's the other factor. Yeah. And they can basically say, well, our mortgage books are fine because everybody's up to date with their payments, etc., etc. Despite the fact that we're still building these bigger problems for later. And remember that if you don't have capital growth in the property sector, then the chances are when you come to sell that property later, you may not have enough in it to be able to repay the loan. So now that we're not out of the woods on this.
And Tasmania is actually leading now in terms of that stress.
Yeah, so this is my mortgage stress, cash in, cash out, money in, money out. So it's a cash flow view of mortgage stress, not a particular percentage. And unfortunately, Tasmania, on a percentage basis, now has the highest proportion of households in mortgage stress. We've seen that move up quite sharply. And that's because, of course, Tasmania as an economy is very reliant on tourism, very reliant on the education sector. Frankly, we also had a run up in house prices and mortgages just beforehand. So all of those factors have come together and pushed Tasmania to the top of the list, followed then by the NT, Western Australia. But of course, the big pools are in Victoria and New South Wales. And we're seeing, significant stress. And it's not just in one or two locations. It's quite widely spread.
Yeah, that is really a shocking figure, isn't it? Nearly half of all Tasmanian mortgages in some form of stress.
Yeah, and just to be clear, this is cash flow. So what it basically says is people are struggling with the money coming in and the money that they need to pay out on all their commitments, including their mortgage. Now, they may have assets, they may have deposits and other things too, or they might tip into credit cards. But this is not a sustainable situation. And typically, 2 to 3 years later, mortgage stress then turns either into a forced sale or a default or something else, some other event to try and actually get out of financial difficulty, because cash flow is king really when it comes to trying to assess where people are. And by the way, half of households I survey still don't know, still don't keep a cash flow, still don't understand what's coming in, what's going out. So many of them are flying blind.
Yeah. All right. So by suburb, again, we've got Launceston, Tasmania, coming in at about eighth or something there, Martin, but still a lot of New South Wales suburbs.
Yeah, well, Ballarat actually 3350 is the most count now, and of course that's out in regional Victoria. And then we've got some other Victorian ones closer into the suburban areas around Victoria. Then we go to the west. They've still got issues there, but it's quite widespread. Launceston's there on the list. Cranbourne, which is a sort of an urban development, highly developed area further out from Victoria there. So yeah, there's a list there, and you can see that more than 7,000 in some postcodes. Now, people ask me, why do I show numbers rather than percentages? And I do on some of the other charts show percentages. But the point about numbers is it's about the volume of people impacted, because it's about the marginality of those households and what they might do. You only need a small proportion of households to move from being in fine fettle to being in difficulty to really tip the economy over. And that's what I'm beginning to see with some of these numbers.
Yeah. South Australia postcodes, anything to add to that, Martin?
Well, I thought I'd just give an example and just go down one level further. So this is South Australia, because we never talk about Adelaide, a very small area. But so I thought we'd do that today. And it's interesting that in Adelaide, some of the postcodes quite close into the centre of town are in difficulty. And, there are one or two there where you've got 4,000, 5,000 households. But the next slide is the important one, because that shows it in mapping terms. And I do this for all of the postcodes in the major urban centres. And what's interesting is if you look at this, the reddy, sort of pinky reddy colours are the more stressed. And what you can see there is in particular postcodes, there are quite high concentrations of people with financial issues and particularly with mortgage stress issues. Now, what I find often, there's a strong correlation between the higher levels of stress and then home price movement down later. So the point to make is that mortgage stress is an early indicator, not only of financial difficulty, but also potentially the trajectory of home prices. And so we should expect to see some home price degrading in some of these areas. And you can look at it across the country. So Mandurah, for example, in Western Australia was one I saw a couple of years ago with it turned red, and now we're seeing all of the issues there with home prices falling and with people negative equity. And now, of course, we've even got social issues down in that area with drug use and things. So unfortunately, there's a bit of a story that you can tell. And mortgage stress is a very good leading indicator.
And all those maps are available on your website, aren't they? I'll link those below. Or?
Yeah. So in fact, I've run a couple of shows with them. Once we've done this show, I'm proposing to put all of them up onto the DFA blog, and people will also be able to download the full pack, because there's a lot of information which I can't necessarily share otherwise. So that people can actually go look at the pictures.
Awesome. I will link that down below if Martin sends that to me after this interview. So rental stress is a different story here, really, although I guess Tasmania is still, in terms of percentage, really high, which surprises me a little bit. And is this the Airbnbs coming through, Martin?
Yeah. So that's a really interesting factor that's gone on here. So this is looking at rental stress from the point of view of not the investment property holders, but it's looking at it from the point of view of those in rental property. And there's a relatively small proportion, if you look at the number there in Tasmania, but we're also seeing, again, the same cash flow issues driven by tourism issues, driven by lack of income and those sorts of things. But what's fascinating about this is that there are some strong correlations between mortgage stress and rental stress. 1.75 million households in rental stress, more than 3.5 million are renters in Australia. 1/3 of the total population rent. right? But what this also has is it reflect on this in terms of if you're a property investor and you used to be able to get rental streams from Airbnb, well, those have gone pretty much at the moment. So your rental streams have dropped. We're seeing rents dropping in a number of different areas. And so therefore, a lot of the property that were investment properties are now not really very economically sustainable. And another reason why I think there's going to be a bit of a run. And I'm seeing about 12% now of property investors signaling that their intent probably to sell over the next 12 months. That's moved up from 8% last month, and half of that move was actually Airbnb.
Yeah, and we had Neil on, a broker who's a friend of mine, to talk about what he's seen and the changes on the front lines. And I know you get some guys from the front lines as well, so they're always interesting to hear what's happening there.
Yeah, and of course, some of them are always bullish, as you'd expect from real estate guys. Others a bit more maybe level opinionated. But look, the fact is, got to look granular, right? You got to look at individual postcodes, individual locations, because averaging doesn't tell you much.
Yes. Okay, last couple of slides, Martin. Some more rental stress of the postcodes
I
across
just
Australia.
thought I'd show you this one. So the Melbourne 3000 is the most rentally stressed postcode in the country, right? A lot of high rise being built there, a lot of apartments, a lot of students, a lot of people also paying top dollar to live close into the centre of Melbourne. And that's quite interesting. So you can see that that's one example. Then you go out to the urban fringe. So places like, Cranbourne, Helpers Crossing, both in Victoria, or Bondi, or Darlinghurst in close to Sydney. So some people close in, some people further out. So again, rental stress is not just concentrated in particular locations. And I have maps. I haven't published them yet, but I may later. Maps of rental stress, and there's some interesting correlation, but also some difference between that and mortgage stress.
So Sydney's not on that list, but it is interesting. We've got Melbourne, Bondi, South Yarra, South Bank. So these sort of suggesting that it's not necessarily the most expensive places. It's more maybe the places that are maybe overvalued, that people want to pay a premium for, but there's not necessarily the higher paying jobs. Does that sort of make sense?
Sure. Well, I think that's part of it. And remember, of course, we've got a quarter of the working population underemployed or unemployed, and we know that that's having an impact on incomes as well. Remember also that there's been a lot of building in some of these postcodes in and around the centre of Melbourne. If you go down there, everywhere you look, they've got these high-rise blocks, many apartments, many very similar apartments. So there's a lot of people living quite close in. So it reflects, I think, what's happened over the last 4 or 5 years. But I'm actually most concerned about Melbourne and Victoria in terms of the property market over the next 2 to 3 years because of what I'm seeing here.
Okay, that is interesting. Have you changed any of your outcomes here, Martin, slightly?
Yeah, I just wanted to highlight that I think there is a path over the next couple of years. So this is my scenarios over the next 2 years. There is a path to more house price growth. If we get all of the government stimulus flowing through, if we get a bigger bounce back in terms of employment than perhaps people were originally forecasting, and the fact the virus, runs its course quicker, or we can adapt to it quicker, there is a path to house price growth, maybe 5 or 10% over the next couple of years. Now, I didn't really have that a couple of months ago. I started recognizing it last month. I've given it now a 10% weighting compared with 5%. My main case still, though, is for price falls because of this debt and because of the high mortgage stress that I'm seeing in my data. And therefore, I'm still probably of the view that prices are more likely to go down rather than up over the next couple of years. But the risk range of up or down is much more spread now, because if we get another run of the virus and a global disruption or uncontrolled pandemic, that could really drive prices down. But there is also a baseline view now based on what the government's looking like it's going to do, and just throw more money at the housing sector again. The one that announced, day before yesterday, in terms of the renovations, is just a good example of misplaced policy, in my view. We're going to see more of that, I think. We're going to see more first-time buyer grants. We're going to see more incentives for people to borrow more. So we're going to go around the debt trip one more time, because that really is the only policy that the government has.
Yeah, and that was something that I know you've been talking about. We predicted that in our documentary over a year ago. In Tasmania, they've got builders grants of, I think it's 20, and then I think, let's say, some friends of ours will qualify for both, so that's like $45,000. And a lot of these pools demand 40 if you're thinking of doing a home. I'm not sure who was on less than 125 grand, who was thinking of doing a $750,000 renovation. So a lot of that sort of doesn't really make too much sense. And I don't think there's going to be a big uptake of that program at all. I think that's going to be a flop. But yeah, they're going to put everything behind the housing market. And the same with the stock market. Don't be surprised if it turns into this parallel universe. If the super wealthy can borrow more money at 2.2% on their mortgage and lever up, and it's becoming clear that the government and the regulators even, they're going to backstop this and not let it go down, it's just going to drive inequality. And the thing that breaks the straw that breaks the camel's back is maybe this political and civil unrest. I'm not sure.
Well, I think it's interesting. I mean, the government is going to try and keep prices up until the next election, right? So they want to go into the next election with no real damage to home prices. That would be, I think, their first policy objective. Remember that ScoMo, when he was positioning just over a year ago, said we're going to keep house prices high. So that is number one objective, and they will do everything. Now, with migration gone, and frankly unlikely to come back, we're not going to see a migration push, with property investors now looking to sell rather than buy because of the fact that the economics don't work much more. It's all down to, can you find a greater fool, go and buy a property, and can you get them to go buy quick, right? First-time buyers, cannon fodder. People wanting to upgrade, probably. I wouldn't be surprised to see further tax breaks. They will do absolutely everything because the reason they want to avoid home price falls is partly because of the political. The other is the direct impact on the banks. If prices start to fall, then they've got to put more capital against the lower loan-to-value loans. And if they go into default, the loans go into default even more so. So everybody wants to keep this party going a bit longer. So they'll do absolutely everything they can. It's not good for the economy. It means we're not investing in the things we should be investing in terms of long-term infrastructure, in terms of positioning us for a better economic outlook. But, it's a political agenda. And I think that the announcement with regard to the Renault, it's purely political. It really does have very little impact.
There was a parody account for Paul Keating saying that it's called the Vote Keeper program, this package. But a lot of people were saying it should be put into affordable housing. Science, education, put it into anything else. But why is our first response, how can we pump house prices another 10%? And it just makes them out of reach for the average, majority who aren't getting wage growth or don't have a job. The other thing I just want to touch on quickly, I think the working from home that is going to impact things. So if you can have a job where you can work from a nice suburb where there's less COVID, less riots, as long as you've got decent internet connection, which can be an issue in some Australian suburbs with NBN. But if you tick all those boxes, I think we've started to see already reports of New Zealand being a prime location for the wealthy, even Tasmania as well. So maybe some of those nice suburbs all around Australia, the old dream of having the backyard and a nice quiet street is different to living in Melbourne and having the most expensive, coolest apartment, those type of things.
Yeah, you're right. I think there are going to be significant social changes. And in fact, if you go to the next slide, another example of that is retail, right? So with the online, this is the data that came out yesterday, that online is now 11.1% of all retail. That's up from about 5.5%. This is a dramatic change. No wonder terrestrial retailing is just falling over left, right, and centre. And of course, retail sales dropped dramatically over the last month after the spike the previous month. Households are not spending a huge amount on retail because they don't have the money to spend. They prefer to save it. But that sort of switch to an online world where effectively more and more stuff is being bought online, I think it's a very important part, because you're making a really important point about this could rebalance. CBDs could become less important. Office space will become cheaper and more available because less people will need to work in offices. And all of this is going to potentially signal a whole bunch of social transformation and change. We haven't got our heads around that as a country, I think, yet. And my view is we need to incorporate that into our planning policy, into our investment policies. And frankly, just throwing more money at building more properties wherever is not going to help us. We need a much smarter way of thinking our way out of this. There is a great opportunity, to invest more in those things for the future. Unfortunately, the decision's being taken. I interviewed a senator up in Queensland the other week, a really interesting guy, and he's basically, he's in the parliament now, and he's saying, this isn't making a lot of sense. So he's arguing much more for infrastructure, or a national bank to help investing for the future. There is an alternative path there, but it's really getting no voice at the moment.
And I think Australia was behind the times in terms of like Amazon and online shopping. It's just ridiculous. I think it's $1 out of every $2 in America now is spent online. It was just something crazy like that through Amazon. So we could play catch up a little bit. And the second order effect that has is Sydney CBD vacancy rates are at the highest since the 90s, I think I read the other day. So we've got all these real estate investment trusts and these fancy packages that are similar to the CDOs in the GFC, and now we've got the CLOs in America. So these are the things that are derivatives, house of cards. Everyone tried to withdraw out of their super the other day, and we had a lot of people in these real estate investment trusts where they can't sell these properties that are part of these trusts. And that's when they said, no, you can't withdraw, you can't even sell because we don't have any buyers. And this is the house of cards where the government have to keep the bubble going.
Yep. And, more sectors of the economy will get more support from government. Just remember that in Japan, 40% of the Japanese economy is owned by the central bank.
Yes, yeah, we are heading. We did a video called "Turning Japanese" with Steve Keen over a year ago, and it's certainly playing out. So, the trade surplus, Martin, again, this is pretty good news compared to a lot of other countries who are running multi-trillion-dollar deficits. Australia's got a surplus still.
Yeah, it's pretty interesting. This came out again yesterday. This is for April, and in fact, we hit a record surplus back in March of 10.6 billion, right? And then it came out at 8.8 this time, which was higher than what people expected. And if you look at it carefully, it's quite interesting insofar that lots of moving parts. We still exported a lot of iron ore and those sorts of things, so people are still taking that from us. But the most interesting for me was on the import side, where overseas travel by Australians fell by 2.75 billion. It was down to 49 million, and that's wait for it, a fall of 99%. So you can see that there are massive movements in these numbers, right? Yeah. And so in a way, how relevant will these numbers be ahead? Not sure. But the net effect is there's a bit more support perhaps for the economy than some are thinking. So it'll be interesting to see just how bad the GDP number will be at the end of June, which of course we'll get a month or so, 2 months later. But there are some interesting signs.
Yeah, and obviously that balance comes from the big gap, and it is the imports that have really fallen off the cliff that have the biggest impact on this number. And so what that tells me that in the pipeline, we're still exporting a lot of goods to the rest of the world, but we are importing a lot less goods, and I'm not sure what the makeup of that is in terms of commodities, because we don't manufacture a lot of things from scratch. But either way, the businesses that manufacture things, and then that goes to the warehouse, and then these businesses. So this is all sort of flowing through in terms of inventory, and it just tells me that the Australian economy is not doing a lot. It is very dormant at the moment because everything we're importing is just gone kaput.
Correct. And, things like inventories being run down, the fact that many companies are not importing as many raw materials as they used to, simply because they don't have demand for them. All of that is there as well. So I think the worry is that this could mask significant issues. As I said earlier on, a lot of small businesses definitely struggling at the moment. A lot of the manufacturing sector now struggling. There are really tricky paths ahead. And remember, of course, we've still got the September cliff. What's going to happen there? Are we going to see job keeper turned off or tapered down? What happens with the banks? Will they start asking people to start repaying their mortgages? All of those things are unknown unknowns at the moment. I think that we've got a lot of tricky months ahead. And that's why, going back to our conversation at the beginning, the gap between where the markets are going and what they're thinking and what I'm seeing with the real data in the real economy is getting more and more diverse. The question is, who's right? Well, I guess we'll know in a year's time.
And finally, just to touch on the Aussie dollar, because it's something I'm getting a lot of questions about. We saw that panic, that capitulation to 55 cents, and I sort of said, look, as a trader here, I think we're going to have a bounce because that was a genuine capitulation, and I didn't think we're going to get up to 69, 70 cents where we touched. What happens in my mind if we start to get that premium location to live, if geopolitics and these riots were in every state in the US yesterday, if they've got COVID numbers that haven't really died down and they start to pick back up, and then they've got these riots, the election, there's a lot of uncertainty there. Maybe Australia can become the cleanest dirty shirt in the laundry for the time being when everyone else is in more trouble than us, even with all the issues that we've spoken about today with the Australian economy.
No, you're right, and that's really the point, right? So, relative to other countries, we are doing reasonably well. We've still got issues, and let's not overplay those issues. They are significant. But yeah, you're right. Relative to what's happening in Europe or in the US, we're looking pretty good. And of course, the US dollar's got a bit weaker, which is one of the reasons why our dollar's gone up a bit. But of course, this doesn't help Phil Lowe, right? So, in terms of importing inflation, this is the last thing that he wants, because essentially his strategy would have been to take the dollar lower to bring more inflation into the country. So this is another signal that we might well get all that extra demand coming in, but inflation could well stay lower for longer than everybody's expecting. And we've had this conversation before, but just to sort of quickly over it again, there is a scenario that says we're going to get into an inflationary future, but there's also a deflationary future. And with where the dollar is at the moment, it's steering more towards deflation rather than inflation.
And Phil Lowe is going to have to do a backflip like all these other central bankers, and he's going to have to start to contradict himself and start to print a lot of money and do things that he doesn't want to do. And I don't think he's going to be comfortable with that. So very interesting times.
It is, and as normal, we catch up every month and everything's have changed from last month, but it's also part of a bigger picture that is still heading in the same direction.
Absolutely. Well, Martin, I always enjoy these chats. I learned something. I'm sure everyone at home does as well. So we'll talk to you guys next month. And thanks for joining us, Martin.
Good to talk to you.
Thanks, guys.